Okay, so let's look at a quick example here of just what that looks like when we have a financing arm consolidated in our standard financial statements, and how we think about unconsolidating them. And I'm going to keep it really simple here, just for ease of exposition, but hopefully you recognize that just because this example might look simple, in practice it's definitely not that simple. Okay? So here we've got a firm, I'm just going to call it Finance Company. Now, last year the company sold $1.1 billion worth of machinery at a cost to the firm of $800 million. The company finances a significant percentage of its products for its customers, right? So you can imagine that this is companies, say, like Caterpillar or John Deere. They sell massive, big machines to people who can't afford $1 million tractor, so they finance it, right? And the company finances those products, and they generate $300 million per year in lease revenue. The company has $3,500 million, that's a weird, $3.5 billion in financial receivables to finance their leasing business. So this is the money that their customers owe them, the ones that have financed through them. And to finance that, to provide the money for that, they raise securitized debt that's collateralized by the financial receivables. So they also have some general obligation debt, and that's what they use to fund their everyday operations. So you can see all that reflected in the financial statements for the firm. They've got an income statement, sales of machinery, revenue. This is lease income, basically interest from their loans, their leasing operation. That gives us total revenue of $1.4 billion. They have the cost of goods sold. That's the cost of making the machinery that they sell, but also the interest expense on the financial products that we borrow in order to loan the company money, right? Remember that a bank is just more or less a middleman. If this company is going to loan its customers money to buy the product, it does so by borrowing from a bank, more or less, or potentially by issuing a bond. And so it does the borrowing for its companies first. And so then the revenue generated by the financing arm is the difference between the interest income that they get from their customers and the interest that they have to pay on the loans they take out. And so hopefully they're charging more interest to their customers than they're paying on the loans they take out themselves, and that difference is the money they make. And you can see that there. They've got operating profit of $350 million, and then they have they also have interest expense on general obligation debt. And this is debt that they just get to fund their operations, right? So GO debt is different than their financial products debt. Finally, we're at net income. So this is a consolidated income statement and balance sheet. You can see on the balance sheet side, they've got operating assets. That's the assets they use to make their machinery. Financial receivables. This is the value of the total amount of loans or leases that their customers owe them. Right? That's what a receivable is. I have sold something on credit. I am waiting for my customers to pay me back. They have a considerable amount of receivables because they've loaned a lot of people money to buy their machines. Right? Those are assets. On the liability side, I've got operating liabilities, just normal liabilities. I've got GO debt, general obligation. That's normal debt that I use to fund my operations. Then I have debt related to financial products. And notice that this again is a difference. I have $3.2 million worth of debt that I borrowed. I then turned around and loaned $3.5 million out worth of value, and that's how I'm creating value. I'm borrowing less than I'm loaning. And then you got book equity in there, and then total liabilities. Right? What we have to do to value this financing arm is try to unconsolidate these statements. So you can see that here. Right? We want to separate the income statements so that on the one side we have the manufacturing arm, on the other side I have the customer financing arm. And if I can do that, then I can value these as separate companies. So I separate it out and I look at the manufacturing arm, and now I just have sales, cost of goods sold, then my operating profit. Then I have my operating assets and liabilities, my general obligation debt, and what's called allocated equity. And this just means that I've taken the book value of equity and I've split it off based on the relative value of the two subsidiaries. So the manufacturing arm has the most value, it gets the most equity, but the equity holders still obviously own a portion of the financing arm, or the same proportion of the financing arm, and so we put some amount of allocated equity over there. On the financing arm, it's just the bank information, basically. I have revenue from financial products. That's my lease interest. That's what I'm getting from my customers. I have interest expense. This is the interest I'm paying on what I borrowed from banks or bondholders. Then my net income is that hopefully I'm charging my customers a higher rate of interest than I'm paying my own bondholders. And I'm charging them $50 million extra. And then I have my financial receivables. That's what I'm owed. My debt related to financial products, that's what I owe. And then my portion of the allocated equity to balance the balance sheet. Now notice that we have return on invested capital on the manufacturing arm of 12%. And then we have what's called return on allocated equity. Again, this is an equity-based model, not an operating-based model. So it's different from a DCF. This is the kind of model we would use to value a bank. It has sort of the same interpretation, but not quite the same. But notice that the return here on equity is 16.7%. So the financing arm has a better return, but that's because it doesn't have any costs, right? It doesn't cost me anything to borrow money from one person and lend it to the next. And so we typically will see customer financing arms providing a much better return. That's why we don't want to consolidate it with the operations of the firm, because it's going to distort our view of the operations and make us think that that company is outperforming when maybe it's not. I mean, maybe it is, but we don't want that to be biased in any way by the financing information. So we unconsolidate and value separately. We've got some other smaller non-operating assets to talk about. They still show up quite a bit. We see tax loss carryforwards. Again, this is a sort of a credit account. We've made a loss. The government has given us a tax credit. We can use that tax credit for up to the next 18 years to reduce owed taxes. Right? So next time I make a profit, I can send the credit in instead of actually paying my tax bill. This is a way for companies to or for the government to let struggling companies either get back on their feet, or often for young companies that haven't started to make a profit yet to not just be totally ruined by taxes, and to have a chance to get forward. Now, what we need to do is forecast this account. We want to understand how much I have, right? So if I have $1 billion in tax loss carry forwards, obviously I'm not going to have $1 billion in taxes in any given year. I'm going to be able to use that over the next 18 years. I need to be able to try and forecast my use of those. And if I'm potentially forecasting any future losses, and so an addition to my carry forward account, I want to try and forecast that too. And so I'm going to forecast that out for the entire length of my forecast period, whatever that is, 10 or 15 years. And then I'll take the discounted value of those future cash flows, and I'll discount that at the yield to maturity, the cost of debt. Okay, so remember, I'm valuing all these assets here, and the value of anything is the present value of its future cash flows. Well, for my carry forwards, the future cash flows is how much of this credit am I going to get to use over the forecast period. And my discount rate won't be WACC, it'll be the cost of debt. So if I have some discontinued operations, this is things like I'm folding down a plant that I used to run, or something like that. I'm closing down an arm that operated in a country and I don't operate there anymore. I've got these sort of valuable assets that I'm trying to sell but I haven't yet, basically. Book value is the most reasonable approximation. So what I do to value this is I just go look at the last historical book value, okay? And that's it, because I don't have a good way even to go about trying to estimate, say, the value of a closed plant in Colombia. I don't know what that is. I don't have a good way to do that. I'll say whatever the company chose to list that value at as its most recent book value, that's what we'll go with. Unless this is just like outrageously large in the balance sheet, it's not going to affect our valuation that much. If we got excess real estate or some kind of unutilized assets, we're going to use an appraisal value or a multiple, or potentially discounted future cash flows depending on what the unutilized asset is. Right? But excess real estate is usually things like the firm moved its headquarter location from one building to the next. It still owns the old headquarter location. It's renting that out, and that's excess real estate, something like that. If we have an appraisal because we're trying to sell it, if it's generating cash flows because we're leasing it out, those are the ways that we try to value this. And again, we're just valuing all these things and adding them to the value of operations. Okay, so that's our non-operating assets. We identify each non-operating asset. We value the non-operating asset according to what we know about it and what kind of information we have. Then we add all of those values to operating value to get enterprise value. Then we're interested in calculating what's called equity value, and to do that we are going to deduct any non-equity claims from enterprise value, and what we're left with is the residual equity value. Right? So there are four sort of big types of non-equity claims. The most common one is traditional debt. So this is corporate bonds, any kind of interest-bearing debt facility. So short-term, long-term bank loans, credit lines, anything like that. That's the first claim. It's probably going to have priority claim. Then debt equivalence is anything that looks like a duck and talks like a duck, but isn't called a duck, right? And so there's a bunch of different kinds. We've talked about lots of these. We'll talk about it a little bit more. Hybrid financial claims. So these are the things that we typically owe to employees, either stock options as compensation, convertible bonds that we've got for some reason, any kind of hybrid claims. We are, or like initial coin offering, things like that. It would be really weird. It wouldn't be something that you would probably have experience with. You'd have to just learn how to deal with that each time you found something new. And then minority interest is the portion of a subsidiary that's owned by other companies. So I own 10% of my subsidiary, a different company owns 10% of my subsidiary. That is technically a claim on my asset, and so I have to list that as a claim.